Hi, everyone, and thank you for joining our 2022 Tax Law Considerations Coffee and Conversation webinar. Given how many people have registered for this session, it seems like taxes are a very popular topic, so welcome. My name is Cecile Holtz. I am a partner and private wealth advisor with Argent Bridge Advisors. We have two outstanding guests today, Michael Osinski and Maggie Lust from Dixon Hughes Goodman. They're both certified public accountants or CPAs, and they are both a wealth of knowledge when it comes to taxes and tax strategies. They work with businesses, business owners, not-for-profits, and high net worth individuals. On our agenda today, we'll be talking about tax changes and what is new and not new for 2022, how to proactively plan for 2022 and beyond for both retirees and individuals still being in the workforce, and what to possibly expect in the future. So before we get started, I'd like to say that we will be welcoming questions. So if you have a questions, please don't hesitate and submit it in the, I think there is a Q&A box. Please don't submit it in the chat. If you have a question, put it in the Q&A box. And we'll definitely do our best to answer it. And if by any chance we don't get to it today, we'll make sure to follow up with you. So I would, let's see. Okay, that's good. So I'd like to welcome you, Maggie and Michael. Thank you so much for joining us. So last year we heard so much about, well, a new tax reform is coming, we have to be ready. And then we waited, and usually any kind of reform like that tends to wait until the last minute to be passed. But we did hope that expect rather that something would pass and nothing happened. So we were expecting to have a different tilt to this conversation today, but can you tell us what changed in anything in 2022 and give us an update on the tax front?
Sure. Thank you so much for having us. I'm really happy to be here and share what we know about taxes. So there are a few changes and things that we would like to share for 2022, a few tax planning things to consider. So the first is the 2022 retirement account contribution limits. The 401k contribution limit has increased by $1,000 for 2022. It's up to $20,500. However, the Roth and traditional IRA contribution limit has not changed. It's still at $6,000. There is a new required minimum distribution table or RMD table, and that's actually the first in 10 years. So back in 2018, the IRS began a new study on life expectancy to update those tables, and we do have slightly lower RMDs for most ages. So that's really good news for everyone because that could save you a few $100s in taxes depending on what bracket you're in. Another thing that we'd love to mention are neighborhood credits for Virginia and Maryland. We picked those two states out because we figured most of your clients on this call would be filing in Virginia and Maryland. So they both have credits that benefit certain 501c3 charities by providing a credit to those who donate to the charities. The states give the qualifying charities a certain amount that they can give to donors as a credit on their return. So for Virginia, it's called a neighborhood assistance program, and there's a giving floor of $500 to get the credit, and the credit is worth 65% of the value of the donation, and that's for businesses and individuals.
That's so good to know.
Yeah. So an individual is limited to a maximum donation of $125,000, and the credit is offered up to 65% of the donation. And so $125,000, 65% would be $81,250 in credits. And that credit is non-refundable, but if it exceeds the Virginia tax liability, it can be carried forward for 5 years. And then for Maryland, it's called the Community Investment Tax Credit Program. And again, businesses and individuals have to donate $500 or more, and the credit is only 50% of the value. And they can claim a maximum of $250,000. So that equates to a gift of $500,000. You can always give more than the maximum. However, you would only receive the credit up to the maximum.
That would be nice. I don't think these credits are very well known. I know until you both mentioned it a few weeks ago, I had never really heard of them.
Yeah, I don't think a lot of people know about it, and it's great because it benefits individuals and businesses. So if it's harder to take the standard deduction because the Tax Cuts and Jobs Act raised that. So this is a great way to still be able to give to charities if that's something you feel like you really like to do, and receive the benefit on your tax return as well. Another credit is the ERC or Employee Retention Credit. I think a lot of people have heard of that, so I won't get into too much detail, but it is a refundable tax credit for businesses. It encourages them to keep employees on their payroll. There are a few tests out there so to see if you've been harmed by COVID or if your gross receipts were affected. But because a lot of people have heard about it, I definitely won't get into it unless people have questions about it at the end. And the last thing I did want to mention is great news for businesses and Schedule C businesses as well. The IRS has updated meal deductibility from restaurants to be 100% deductible. They still have the 50% deduction for other snacks at grocery stores and such. But if you purchase a meal, whether it's dine-in, takeout, doesn't matter where you consume it, it is 100% deductible for tax years 2021 and 2022.
Okay, probably trying to bolster people coming back to restaurants and such.
Yeah, so if you have in-office meals, if you take out, go to lunch, it can be deducted. So
great, good to know. Wow, that is a lot of information for tax reform that was not passed.
Yes, so maybe I'm sure if the BBBA was passed, this would be a much longer conversation.
Right, it would probably take the full hour in itself. So
definitely.
What about, something that people are curious about is the past 2 years, the IRS has extended the tax filing deadline. Anything new for this year, or are we back to the old rules?
We are back to the old rules. As of now, I don't think you should anticipate it being extended. However, Emancipation Day is a holiday in DC on Friday, April 15th. And by law, DC holidays impact deadlines the way that federal holidays do. So the tax deadline for individuals is Monday, April 18th. All state returns are due that day as well, except for Maine and Massachusetts. If you happen to file there, they both celebrate Patriots Day on Monday, the April 18th. So their deadline is Tuesday, the 19th.
Got it. But don't wait that long to contact your CPA and provide all of your tax information. They won't be happy with you.
Please do not. And if you do, we will probably have to extend.
Right. I read something this morning about potentially refunds being delayed and things like that. Any thoughts on that, or any idea? Not that you work for the IRS or anything like that.
Well, while I don't work for the IRS or the state departments, I do deal with them a lot. And I'm sure Michael does as well. But just with, the staffing shortages and all of the changes, especially with the child tax credit, they are overworked and understaffed. So there are a lot of delays. We definitely recommend any e-filing and payments, direct deposits that you can do, and direct debits. It would make things go a lot faster. And I believe I read that if you are receiving the child tax credit, it will take a little bit longer to get that figured out. So the earlier you can file and the more electronic, definitely the better, but you just need to be patient, unfortunately, with the government.
Right. Okay. So expect to have a normal deadline of April the 18th, but on the other hand, there might be some delays getting a refund or anything like that. Okay, so thank you, Maggie. So since there is no tax reform, if you don't mind, I'd like to focus a little bit on proactive tax planning for 2022 and potentially beyond. So starting with people who are still in the workforce, still earning a paycheck. Recently, we've heard a lot about the Mega Roth. Can you tell us more about that? What does that mean?
Mega Roth, think of it as like a Roth on steroids. For those who don't know what Roth is, right? I guess in IRA vernacular, individual retirement accounts. You have essentially 3 types of accounts, right? You've got traditional, which can be deductible, or traditional non-deductible, and then you have The key difference with Roth is that the investments that you put into Roth grow tax-free forever under current law. That makes that a very powerful tool. The
Right.
second component of Roth that makes it even more powerful is that you don't have a requirement for RMDs out of a Roth account. You literally can never take money out if you don't want. You can pass away, and you can pass that on to your heirs who also inherit that tax-free nature, which makes it a very, very powerful tool for the wealthy who essentially don't need a lot of the money that they have, and they're looking for ways to pass it along to the next generation. So this is a heady tool used by them. When you talk about mega backdoor, that's essentially working through your employer. So as Maggie outlined, IRA requirements are pretty low. So when we talk about our traditional backdoor, if you make high income, we can talk about what those limits are. You can Google those. It depends if you're married, if you're single, if you're married filing separately. There's different limits of income upon which you can't make a direct Roth IRA contribution. The backdoor, in essence, says that you can make a non-deductible contribution at any AGI, any income level, as long as you have earned income. That limit is essentially $6,000. There's more money you can put in if you're over 50. And then what we tell clients is if you don't have any other IRA out there, and that's an important thing to note, if you have no, you make that contribution, you leave it in cash for a day. And the reason we leave it in cash for a day is that we don't want any growth or any shrinkage, right? And then we convert it, and then you buy whatever it is security-wise that you want to buy. And then you're looking to maximize growth because all that growth then is tax-free.
Right.
If you invested in something like a mutual fund before you did the conversion, and let's just say you were in there for a day, even if the account went up $100, if you do the conversion, you can still do the conversion, but you have to pay tax on $100, and the whole to avoid that. So the backdoor IRA is putting in a contribution that's after tax dollars, waiting in cash, converting it. The mega is essentially using an employer plan to do that to a much larger extent. So you run into what we call compensation limits that are out there. In 2021, those compensation limits were $58,000. I think it's indexed up to $61,000 this year. It's hard to find an employer plan that will allow you to do this. But if you want to think about it, you have this bucket of money that's $61,000. Let's just assume you max out your 401k. It's like $20,000, $20,500, I believe. Again, if you're over 50, there's all sorts of other math out there that we can run into. It gets complicated a little bit further because if most employers have some sort of match of some sort to your 401k, and that's so that they can avoid some high compensation testing. And if you want to get into those details, in essence, if I and Maggie run a firm, I'm the partner, I make a lot more money. And what they don't want me to do is pay myself all the money so that I can max out the high contribution of $20,000 and not pay Maggie enough that she can't max out her 401k. In order to get around that testing so that I wouldn't have to have some of my money refunded if I over contribute and I fail that testing, I quote, as an employer, say, I'm going to match 401k contributions. And usually that's anywhere from 3% to 5%. And what that does is it gets me out of that testing. So then if I'm that high compensation person, I get to put my $20,000 in. I have no fear at the end of the year of running afoul of testing and having some of that money refunded. It benefits Maggie because she's getting a little extra money, but ensures essentially that I can get my money in there. So usually when companies match, right, that eats into that $61,000 bucket.
Right.
So your 401k, you can even elect, depending on the employer plan, whether that's a traditional, meaning it's coming out as pre-tax, so you don't have to pay tax when you get your W-2, or you can, in some employer plans, designate that as a Roth contribution, which means that's also after tax. So you're paying tax then on your W-2, but you're putting in Roth directly through your employer plan. That backdoor, again, does the math and essentially says if you have that $61,000 limit, that I've already put $20,000 into my 401k, so the delta is the remaining that I can feed into the back door, meaning that I can post-tax contributions into my employer plan, if they allow it, up to the 61. And then you get into some different nuances. Again, does your plan allow a conversion within the plan? You could simply do that. Or you could do withdrawals. And the withdrawals are, I think they're called in-service withdrawals.
Yeah, in-service distributions.
And the plan has to allow for that as well. So then it becomes very complicated. Typically, if you're in a large employer, you're going to run afoul of being able to make after-tax contributions. The reason is a lot of them, again, have matches or other requirements in their plan to avoid that discrimination testing pitfall. And so it's very, very challenging to find a plan that will have these two provisions that will allow you to do it. In addition, of course, you need a lot of extra money that you can afford to just to sock away and save.
Sure.
You're-
But it's
you're going
powerful
check
if
to
you can
check
do
and-
it. Yeah.
You can. But I think the important thing is to know that you would have to contact HR and to walk through these two provisions, and then you would need the extra cash flow. And I'm sure that, if you are a client of Argent, that you would talk to them and they have a list of other things that you would save money in other places first. That, we all need some sort of cushion financially. You have 529 plans. If you have kids, you really should max out your existing retirement plans first. You can do IRAs on top of that first. So the back door is really, really for a unique set of circumstances where your employer plan will allow you to do it. And you really have a lot of extra cash
Love income, right?
to contribute. Certainly worth looking into, certainly, again, a very, very powerful tool. But I can tell you that, out of our client base, there's just not many people that can take advantage. You're that employer and you're able to control and design that plan. I can tell you someone in professional services like us as accountants or attorneys, very, very unlikely to do that because there's a bunch of other plans that they put in place for partners, profit sharing plans and other things that already max out that $61,000 limit. You may have heard of cash balance plans. There's a bunch that are out there that kind of wipe the ability to do this backdoor mega Roth for those types of professionals. So it's a unique set of fact pattern and it's a unique set of situation that allows a person to take advantage of this.
Okay, thanks for clarifying. So it sounds like there's so many moving pieces that the bottom line is, go to HR, request your summary plan description, and share that with your accountant and or your financial advisor, and then we can assist with this. But as you said, it's a pretty niche idea, but can be powerful in some circumstances. But there's been so much over the news that I thought it'd be interesting for people to hear what actually is it. So it's not this magical trick, it's actually possible.
It's very possible. It's a little bit of a unicorn. Again, it's hard to find a plan that allows you to do this, and you'd have to have a lot of free cash flow. But it's common enough. I think statistically, in the articles that I've been seeing, roughly 33% of plans outstanding probably would allow for this to occur, and then a subset of people who would have the cash flow that could take advantage of it.
Great. So let's switch gear for a second for maybe retirees and some tax planning that we may be able to implement in 2022. So I'm thinking of some of our clients who have meaningful portfolios, meaningful assets, but maybe not that much income. So are there ways to maybe proactively manage your tax bracket? I think a lot of people don't understand that, it's not because you're in the 32% bracket or 22% bracket that it's not, it's basically a progressive tax system. So what things can we put in place so that we can prevent a big jump from the 12% bracket to the 22% bracket, or from 24 to 32? Do you have some ideas and recommendations there?
There's always ideas. I don't know. Maggie's got a few. A lot of it depends on where you are asset wise, how liquid you are, where your assets are. Certainly we look at clients that we have some clients that are very much in real estate. They don't like to be in the stock market. So real estate investors, you look at things like kind exchanges, right? Where I'm essentially selling a property, but I'm not capitalizing on that gain, paying tax on that gain. I'm rolling that over into the next investment. A lot of wealthy people believe in building up assets and they don't ever sell anything. What they do is look for assets that they can leverage. So in the case of real estate, you would refinance it out and you would live off of those proceeds because, depending on what you use the money for, you could still potentially deduct the interest. You still asset. And at least real estate has certainly gone up in value significantly the last couple of years. You've got, if you're trying to minimize taxes, we talk about loss harvesting. I think is common with brokers where,
right. Perfect time to do this right now, right?
Yeah, that I've held forever. And I've sold something at a large gain, call that, Amazon, call that whatever, Apple, call that, whatever other stock that you may have. What I'm trying to do is shelter those gains, in which case then I may be looking at losers, or I may be looking at things that are not performing as well. And perhaps I need to rebalance my portfolio. So it would be a time to look at my losses that may be pent up that I haven't been able to use. In the tax world, capital losses, whether they be short-term or long-term, can only be used to offset capital gains. And then to the extent that you have capital losses that exceed those gains, you're limited to taking $3,000 a year. So I did that going back, what was the last crash? With 2008, if my memory serves or whatever, there was a huge crash. We had many clients with hundreds of thousands of dollars of capital losses. Now, over the years, they've gradually kind of whittled away at those, but it
Mhm.
was people who, unfortunately lost a lot of money during a correction and, was forced to sell, who knows, could be divorced, could be a variety of other reasons, hardship. Now would be a good time to take a look at those losses and, can I offset those with, I want to rebalance if I have concerns, or if I have a lot of gains, it's early in the year, you probably don't have a ton of gains that you've already captured, but maybe you do. You certainly could look at losers that you want to rebalance with those gains. Other things you can look at it to your point of tax brackets. That's where we would look at, perhaps if there's a massive correction, I don't know that we're there currently, but let's just say the market goes down 20%. Again, it would be a time to maybe look at your retirement plan with your employer, and perhaps I want to boost my income up for some reason.
Mhm.
And you could do in-plan conversions. While the market's low, perhaps I sell out of some of my, traditional 401k, and I roll that over and do a Roth conversion. The nice thing about conversions is usually you can pick your dollar figure. So if you kind of have a good breed on what your bracket is, you could find yourself in the 20% bracket. Maybe you're on the low end of a 25% bracket, and you have a little bit of extra cash, and you're saying, well, why not I convert $10,000 or $20,000, within an in-plan conversion. I know exactly what that tax hit's going to be at 25%. It's going to be 25% of that number. So it's $2,500 on, a $10,000, or it's, $5,000 on 20, you might be able to manage that cash flow. And now you're starting to build up again, that Roth portfolio.
Mhm.
That would help you in retirement. And in retirement, that becomes important because then I have multiple baskets, right? I have a basket of taxable money, and I've got a basket of Roth money that's not taxable. I know a lot of brokers that I talk to and a lot of financial planners, they love the Roth because a lot of people retire before they're eligible to collect Social Security or other benefits. And they're looking for a way to balance that very tax bracket discussion. And, the discussion gets into, well, if I have a mortgage and, I've got itemized deductions, I don't want my income to be zero, actually, because I don't want to lose out on those deductions. If I'm a big person in terms of giving to a church or some other charity, I don't want to lose those deductions. I want my income to be up sufficiently that I can use those deductions. And then it becomes, well, how much higher do I want it to be or not? And the nice flexibility in having a Roth pool of money is that I get to pick that tax bracket, and you can be very proactive in picking that number.
Mhm.
Still required to take RMDs, but there's other ways of minimizing that. I think Maggie will talk about a couple of other things that you can minimize the tax hit of an RMD that you're required to take
But
out.
to your point, if you do proactive Roth conversions, and it's a way to minimize RMDs in the future too. So it's a bit of a win-win.
It shrinks the pool.
Mhm.
Yeah, exactly. So there's lots of things you can do with even the financial liquid assets, if you will, in order to set yourself up for a better, more flexible future.
Right. Thank you. Great. And these are all things that we do talk about with clients. So it's good to see that we're in sync about Roth IRA conversions and being proactive about it. And it's not, I think the takeaway here is it's not only the tax impact to your taxes in one particular year. Like maybe in 2022, you're going to pay more by doing those Roth IRA conversions. But if you look at the long term, 5, 10, even 20 years down the road, if you're willing to pay a little bit more taxes this year, then it might better your overall tax picture over your lifetime. So
yeah, and that's usually when talking with someone like you in the financial planning world, that they will run a lot of calculations and projections for you. And really a lot of that is so much that is forecasting. What tax bracket do you think you'll be in 20 years from now?
that'll be my next question.
There you go. So I think generally it's safe to say that government can't stop spending money, and it really doesn't matter which administration's in there. And if you have that philosophy that government keeps spending and the debt keeps going up, at some point the debt has to be serviced. And what does that tell you? Well, the U.S. population isn't growing all that quickly, even with immigration. And so in essence, what you're saying is that taxes are going to have to go up, that you will service that debt.
And historically, taxes are fairly low, right? I mean, it's who knows,
yes,
but
they are hit at a historically, relatively speaking, low point now. Certainly I'm old enough to remember Carter and gas lines and 70% tax rates. Hearing my parents talk about that. So they're certainly nowhere close to that.
No.
So there's certainly room from a United States historical perspective for taxes to go up, and it still not be at the high mark of where we have been. But I think the American public generally appreciates being able to spend the money the way they want to spend it and enjoy lower taxes.
Mm-hmm. Great. So let's think about, we were just talking about Roth IRA conversions. Can you tell me, switching gears a little bit, but we were talking about charitable contributions earlier and how to make them go as far as possible. We talked about RMDs, so tying it back to RMDs, what about taking advantage of qualified charitable distributions? Can you tell us what that is and how that might benefit someone?
So a qualified a QCD or a qualified charitable distribution is from your IRA directly payable to a qualified charity that actually counts as an RMD, but it's excluded from your taxable income. It must be a direct transfer of funds. So if you take a distribution and then you turn around, the next minute, write a check to a charity, that's still considered a taxable event. So why is this important? Additional taxable income may push you into, like we talked about, an increased tax bracket, and it could also actually reduce your eligibility for certain tax credits. So it's a really great way to make your money really work for you, and kind of, be able to make that charitable contribution that you want to, and also help your taxable income, help you go financially farther. So there are a few accounts that are eligible. So traditional and inherited IRAs, and then inactive plans for SEP and simple IRAs. And there actually are a few other ways to make charitable contributions that if you wanted to talk about that too.
Sure. And before, I definitely want to talk about that. I just want to make a point because I learned about this actually just a year ago, and I thought it was pretty interesting because sometimes the logistics of having to have the funds go directly to the charity is a bit of a pain in the neck, but just know that some custodians will actually let you have a checkbook on your IRA where you can write those checks directly. So I don't let everybody have a checkbook because I don't want people to start mixing their checking account checkbook and IRA checkbook and start writing checks from their IRAs. That would not be good. But if you're this organized person, just know it's possible, so that throughout the year, when you make your contributions to charity, you could use an IRA checkbook to make those contributions. So just something logistics that people may appreciate. But go ahead, Maggie. Sorry, I interrupted you.
No, that's great to know. I just learned that too. So that's definitely helpful. Makes, your life a bit simpler. So a few things that I wanted to go over for charitable contributions that would help the taxpayer. Again, so there really isn't a best way to make charitable contribution. It really depends on where you are as a taxpayer, where you are financially. So one thing that you could do if you have the money is a donor advised fund, and that's when you bundle contributions. So it's a private fund that's made up of multiple organizations and it's run by a third party. So it's similar to like a ETF where it's many things controlled by like Schwab, for instance. So you, as a taxpayer, you would make the charitable contribution directly to that fund and you would receive the immediate tax deduction, and you can recommend grants. So distributions out of that fund as you see fit. You don't have to immediately turn around and make a charitable contribution out of the fund that year. You can wait, you can do it as frequently or as infrequently as you'd like. And then you can pick whatever fund that you like the contribution, you like the charities in, which is really great because it's your money and you want to control where you're spending it. So a lot of the funds have a variety of investment options to grow your money, and that the money grows tax-free. And it's really great if you ever want to transfer assets, because you can do that without getting the capital gains tax, and you receive the immediate fair market tax deduction of that. So
win-win.
Yeah, it really is a win-win. We're making it very easy for you to donate. Another thing that you could do is charitable contribution bundling. If you don't want to go through the process of donating to a fund, you can bundle. So like I had mentioned before, the Tax Cuts and Jobs Act did raise the standard deduction. So it made it a lot harder and disincentivized people to make a lot of charitable contributions to get over the standard deduction and into the itemized range. So one way to maximize your charitable contributions and really make your money work for you is to only donate to charities every few years, even as frequently as every other year. So for example, instead of making a $10,000 contribution every year, you make a $20,000 contribution every other year. And in those years, it pushes you over the limit of standard deduction. If you say a married filing joint couple, you have, tax, state tax, local tax, and mortgage interest and medical expenses as well. So you can itemize in those years. And then in the years that you don't make the contribution, you would take the standard deduction. And it's really important to talk to your advisor, tax advisor, especially your financial advisor, to see what your finances are like for that year. If you've done a lot of sales, have a lot of gains, if it makes sense for you to
offset a good year.
Yeah, so that's something you should definitely talk to your financial advisor about to see really when it works for you. And it doesn't have to be every other year on the dot, $10,000 on the dot. If it's every 3 years, really, it's different for every person.
Mm-hmm. No, that's a great point. It's a very powerful tool, and people think it's a lot more complicated than it really is. I think, you mentioned Schwab has a great one. Fidelity has a great one. Super easy. You just create an account. Everything is done online. It's so easy to just give money to the charities that you like. And it's really a win-win all around, like a tax win for you, and then a charity. Even if you give them a highly appreciated security, then they get to not pay their taxes on that anyway, because they're a charity. So it's so powerful. So thank you.
Sorry.
Go ahead, Maggie. Sorry.
I did want to mention one other thing about the neighborhood credits that I didn't mention before, but they're a really great tool. And for example, if you were in the 37% bracket, and you donated in Virginia, the maximum of $125,000, you maximize all your deductions, you would actually save a total value of over $134 between your federal and Virginia bill, which is more than you originally donated. So your return on investment over 100%. So that really, again, depends on everyone. There are a lot of other factors, but hypothetically, you could, save more than you're actually spending. So again, that's just a really great way. And there are websites that you can go on to see what charities are on there. It does change every year. I know for Virginia, you actually do need to fill out a form in order to get the credit, but it's a really great tool to use. And I think, again, like you said, not a lot of people know about it. So wanted to make sure.
And it's one of the advantages of working with a professional like you versus doing it yourself. Is TurboTax is probably not going to tell you about that, right?
Yeah, there's so many credits out there. And if you Google Virginia credits, you're going to go through a long list. So always.
No, I don't think it's very well known. So thanks for sharing this. Let's see. So you talked about a little bit not having a crystal ball predictions for the future for tax reform. Likely, taxes may go up. Anything that we can, other than what we already talked about, anything that we can do to prepare now for potentially higher taxes in the future? Or have we covered pretty much everything?
There's going to be a lot of pressure. Politics is always kind of funny. It's not altruistic for the people. Regrettably, there's two teams out there, and even though they're both playing for the United States, so to speak, not in some ways, because they both want to control the levers of power. And in an election cycle, I think a lot of bets are off. I will say that there's one thing that, as a tax person, there is something called a research and development credit that's out there.
Okay.
And one of the wrinkles that's changing, part of Trump's change in tax law, is that starting in January 1st of 2022, R&D expenses, you can make an election that you can expense them through your P&L, if you will. So as I'm paying researchers, as I'm paying scientists, as I'm paying people to do cyber coding, I get to expense that, which means I get to pay lower taxes. On top of that, I would get a credit. Starting this year, January 1st, provision sunset, and all of those research and development costs had to get capitalized up on what we call the balance sheet. And then they get amortized over 5 years. So that's going to create some artificial boost in tax bills for anyone who's doing research and development. That's one thing historically that both parties have agreed that they want to push forward, meaning renewing R&D credit. When it first came out, it had to be renewed every few years. They finally made it permanent. That is one thing, despite the political headwinds that may be out there one way or the other, I would expect them to address. Other than that, honestly, I think it really is honestly a political football at this point. It is regrettably one party willing to give another party a win to some degree. The only way anything's going to get through is honestly because everything is controlled essentially by the Democrats currently, is that they would have to find consensus within their party. Perhaps they would get some more middle of the road Republicans to join them, but I wouldn't expect any significant change in tax policy. But I think you're maybe looking at some things that would be nibbled around the edges. Like with Build Back Better, I would be surprised if you see anything that's a flat increase in individual rates that impacts in 2022. If you want to think about the time clock, historically, Congress is loath to increase taxes mid-year because mechanically it's essentially impossible to do with ordinary rates. How do I decide how much of my W-2 is taxed at one rate versus another? But they would do that potentially for capital gains rates, which was the big scare last year. With Back Better. But there's a lot of talk of, hey, at the point that they put it out to the public.
Retroactively to September.
Exactly. So that it's possible that they would nibble at something around capital gains. But I think any other potential tax increase, you're really not looking at anything probably until January 1st, 2023, in my personal opinion.
Got it.
I just think there wouldn't be any stomach for doing that mid-year in an election year.
An election year, right. This doesn't sound like it'd be very popular.
I do not think that would be very popular.
Right. So last question, the Tax Cuts and Jobs Act was adopted in December of 2017, and some of the provisions will sunset in 2025. What kind of tax implications can families expect if nothing happens until then, if there's no reform until then?
So that's definitely the key, like if nothing happens until then. We do have a few, midterm elections, regular elections to go through. So I wouldn't guarantee all of these staying the same, definitely sunsetting. They might be extended, but as of now, there are a few provisions sunsetting from the Tax Cuts and Jobs Act. The first one is the deductibility of mortgage interest, and that limit is actually going up, the limit increase. So it will be going back down. It will be going back up. They decreased it. So it's good for individuals because they get to take a higher deduction for their mortgage interest. The next is the zero personal exemption. So the exemption amount in 2017 was $4,050, and that was zeroed out until 2025. And that really hit families the hardest. So it'll be great for the families because they can get an increased exemption. And then the child tax credit, they did raise the earnings ceiling on the credit, so it opened it up to more families and single taxpayers with children. So not as great for families in the higher income tax brackets. I believe that the married filed joint was raised to $400,000, so that will be going, or it's set to go back down. And then, so the Tax Cuts and Jobs Act didn't tax federal and private student loan debt that was discharged due to death or disability. So that's not so great for grieving families because the average student loan debt, I believe, is $30,000 now in the US. So that could be a pretty big chunk of change that you have to pay taxes on if they don't change that. And then the state tax exemption was raised from 5.49 million up to 12 million. So I know that was thrown around.
Per person, right?
Yeah, excuse me.
Per person, right?
Yes.
Per person. So married couples double that, yes.
Okay.
Yes. So that was more than doubled, and that's set to go back down to the 2017 amount. And then the last is the change in marginal tax brackets. In 2026, they're set to go back to what they were in 2007. So absent further legislation, and those tax rates are a little bit more, I think, for most of the brackets, not all of them. So not as great for the taxpayers, but like we had chatted about beforehand, it's not as high as they ever were, but you could see an increase.
So no changes in any tax reform could mean changes in 2025 at the latest, right?
Yes.
It could.
In an odd way.
Got another, presidential cycle before that. You've got several terms of Congress.
Right.
Again, we look at, it's a little bit like the weather today, right? We have inflation, we have other things. And I just think that's a long way in terms of tax code to talk about.
The only constant seems to be change in this game.
There you go, which is good for us.
Good. Yeah, it keeps you employed.
Yeah, it keeps all of us employed.
Right. Okay, well, thank you so much. Let me see if actually don't see any questions. I am surprised. Everybody's listening quietly. Well, if anybody, I don't see any questions pop up, but if anybody has a question, of course, feel free to email it to us, and I'm sure Maggie and Michael wouldn't mind answering it later. Good. Well, if there's no questions, I'm not going to create any. So in closing, I would really like to thank you, Michael, and you, Maggie, for joining us today. You're so enthusiastic about taxes. It's really fun to see, and so knowledgeable. It's just, it comes through, it comes across as how much you know. So thank you so much for sharing your knowledge with us today. And this recording, this webinar was recorded, and the recording will be posted on our website. So, feel free to, if we went too fast over a concept, feel free to go back on our website in a few days, and then you'll be able to listen again. Or if you'd like to share with a friend, feel free to do so. You're more than welcome to do that. So thank you everyone for joining us today, and have a great day. Thank you.
Thank you so much.
Everyone.